Let's turn now to things other than mega caps. Small caps were big underperformers today. The Russell 2000 closed down more than 1%. It's in the red for the year. Despite that weakness, our next guest says it might be time to give the small guys a chance. Joining us now, Joe Amato from Neuberger, Berman. Joe, good to see you. I actually want to start with another insight or idea that you got. Hey, and that has to do with looking at large cap stocks that maybe haven't gotten as much love as the mega caps that are still quality. Now, I have to look back at the definition. Large cap, traditionally means just above 10 billion in market cap, which seems small compared to the trillions that we talk about. But MongoDB, for example, 23 billion. It's the biggest stock in the WCLD. I keep calling that out because we think of tech, you think of that index, but it's down quite a bit. The WCLD is. So how are you defining quality when you talk about large caps, and which industries are you looking at specifically?
Well, you could certainly think about quality in a whole range of ways, right? It's not just about those that are less cyclical. It's you want companies that have a persistent ability to generate cash flow, a degree of pricing pressure, lower financial leverage, sort of moats around their businesses. So you could find those stocks in a whole host of places, not just large cap, but throughout the cap spectrum and within traditionally defensive industries, as well as the cyclicals. So I think quality is a place that right now you want to be, because we see some of the concerns that you have talked about, many of your guests have talked about, which is a level of deceleration resulting from the monetary policy impact that we've seen, of course, over the course of the last 18 months.
Now let's take it to small caps. You mentioned all sizes. They've been taking a beating on days when the markets are down. So how should investors approach growing their position in small caps in a relatively volatile environment? What's the strategy? Is it sort of averaging in? How do you do it without, again, losing your lunch?
Well, I do think you want to leg in, like with any asset allocation. You don't want to jump in at any one particular time because it could be a bad day or week or whatever for a particular asset class. But I think small caps are not typically the place that you would want to be when you're seeing deceleration in the broader economy, right? Now, the question is, have we seen the discount of those concerns fully, right? Small caps are at the levels they've been at, were last at since like November 2020. I mean, before we saw a COVID vaccine. I mean, that's how brutal the small cap space has been. And you've seen this huge migration up the cap size, particularly, of course, in the super duper size mega caps. But we think there's value in other places of the spectrum. It's not just in the super 7. And I think people should start to leg in. And there are ways to play in small cap that are consistent with what I referenced earlier, sort of higher quality, defensive nature, persistent cash flow, very defensible business models.
Joe, I wonder if you're in the soft landing camp, or if you believe that a recession has just been delayed rather than staved off. And I ask that because your answer to that is going to sort of determine whether we're as good as it gets with stocks in the cycle or not.
Yeah, no, that's a fair point, Morgan. I think that we see a deceleration of economic activity, right? I don't necessarily see an economy that's going to fall off a cliff, but there's certainly plenty of signs where things are softening, things are cracking, and those are the things that we're worried about. So that's why we want to be up in quality, up in the more sort of more defensive parts of the market. I don't think you want to have zero exposure to equities, because, oh, by the way, we could be wrong. And if you do have a soft landing and you're off to the races, you want exposure to an equity asset class that's going to do very well in that environment. But in a world where you can get 5, 6, 7% in reasonably high quality investment grade fixed income, in our view, it's not the time to take a lot of aggressive equity risk at this point in the cycle where you've seen this, buildup of headwinds. I mean, just in the long end of the curve, that's created volatility in the past couple of months. So there are things I think you want to watch out for. But it does pay to be diversified across asset classes, as we've always preached.